Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 269 on 17th of August, and we're going to talk about the Adani stocks and how weekend investing strategies have used the trend to get returns for its users, and how a lot of disbelief in the company or in the group has caused a lot of missed opportunity for a significant number of people. We don't know where they will end up in terms of whether this is high valuation or no, or how the businesses will shape up in the next 5 years. But for now, the trend has been strong for last many years, and trend followers should have taken advantage of it. In terms of the markets today, markets continued it is now, I think, many weeks now, third week that we've had a straight run. And PSU banks did very well today, up 2.2%. IT stocks also made a comeback. So there is some sort of a rotation that is happening now. Real estate, which was running up yesterday, has taken a breather today. Autos that were running have taken a breather today. Metals and pharma were kind of quiet, but FMCG, consumption, IT and PSU banks took the lead today. Overall, all sectors have gained in the last 1 week and in the last 1 month and in the last 3 months also. So quite a remarkable recovery from the 15,000 odd levels of the Nifty to now very near all-time highs, less than I think 4% from all-time highs, and many stocks have made all-time highs individually. So good days for most portfolios. In terms of the index gains, Nifty Next 50 continues to gain well, plus 1%. Small caps and mid caps were a bit muted at 0.4%. CNX 500 and CNX 200 at about 0.6% along with Nifty. In terms of the weekend investing strategies, MIATH up 0.73%, MI25 up 0.68%. Nothing remarkable as such in today's figures. Between 0 and 0.75% up, most of the strategies. Some strategies were flat and some were down 0.25% and 0.6%. So kind of a rest day within this rally, and I suspect with this kind of a high RSI on the daily, we may get a shock day someday, one of these days. We don't know how much, but a significant 1% kind of a move should be expected anytime. I mean, that's par for the course. So don't worry if there's a sharp move in the market. That may just be profit taking, and then post that effectively we will have to see how the market behaves, whether it continues the trend forward or comes back towards the 200 DMA. The Heatmap pretty green. Bajaj Twins doing very well. Bajaj Finserv up almost 6%. Bajaj Finance up 3%. HDFC Life is coming back now, plus 3.2% today. It was up yesterday as well. Some IT stocks did well. HCL Tech, Tech Mahindra, Wipro doing well. FMCG stocks, levers, Tata Consumers doing well. Autos, some profit booking here. Eicher Motor, although still going very strong, and Hero Motors adding another 3.5%. Cement stocks were up. Hindalco, Grasim, and Bharti Airtel was also up at plus 2.6%. BPCL also has been creeping up, along with some gains on Reliance and NTPC in terms of energy stocks. So all in all, another decent day. In terms of stocks that are running hard, Ratan India up 20%, Aarti Drugs up 11%, Happiest Minds up 11%, Hykel up 9%, Edelweiss up 8%. So smart gains. Some of them were really laggard category, so I would be cautious on those stocks. Sona BLW is the worst performer, minus 5%. UTI AMC after the run last 2 days, minus 5%. Chalet Hotels are minus 4%, Aegis Logistics minus 4%, and JB Chemicals also lost 3%. Topic of the day to discuss Adani stocks, Adani Group stocks. So uh, you would have noticed that there is a lot of mystery around the Adani Group stocks. And I have no particular reading about the promoter or the group. I am not a proponent of any kind of analysis that I've done. But the price trends are very stark, and they have been this way since the last 2 years. Adani Green is up 546%. Adani Total Gas is up 2100%. Adani Enterprise is up 1556%. Adani Ports is up 152%. Adani Power is up 927% versus a gain of 60% on the Nifty. So while we may have our reservation about, maybe things are running very hot, maybe this is just a bubble, maybe they will all come crashing back, but it is providing you with an opportunity, and capital should be seeking such opportunity instead of lying around in stocks which are not moving. What's the fun of having your capital locked up in stocks which are not moving, when this opportunity is right there? Yes, the risk quotient may be higher, but then you have to diversify the risk away. Take a 2% exposure, take a 4% exposure. What worse will happen? Like, I'll give you an example. In NNF10, I think we bought into Adani Enterprise or Adani Total Gas, and we've made something like 670% on that, and we have been redistributing profits every month on it. So, after having distributed profits of 500% or 600%, if today my exposure is 100 and I've already taken out 500 from monthly gains on it, on top of it, and now tomorrow, even if stock goes 50% down, I've lost only 10% of my profit. So don't be afraid of stocks that is going up. That is the key bottom line. You can only let winners run and have your exit strategies in place, but don't be afraid of stocks going up, because they are the ones who will actually make you the money. Don't love the stocks which are going down, please. That is the cardinal mistake anybody can do. So this is something that we've achieved already in our strategies. Adani Transmission up 679%, Adani Enterprise 191%, Adani Green, these were in NNF10, in MI MT All Cap 390, and most of these have already booked and moved out. I mean, I think one of them, Adani Transmission, is something that we are holding on in NNF10. But most other stocks, Adani Green, I think, is out of most of them. We made 390% in ATH, 406% on Adani Enterprise, 390% also in MIMT All Cap. MI25 also dipped its hand in Adani Green. So different strategies, depending upon the different entry and exit points, would have made different returns. But nevertheless, I mean, why lose that opportunity? I mean, because of our, you can say, bias towards a particular narrative, or if it gets flagged under some filter that you have, that I don't want to buy market cap less than this much, so I will not consider this stock, that's fine. If it gets flagged under some red flag by SEBI or exchange, fine. If it gets red flagged by, let's say, some volume filter, fine. But if it's a legitimately liquid counter, don't let your own narrative, ride or cloud your trend following ability. I mean, you have to remain unbiased to really get hold of such things. And this is where we entered in NNF 10 in February 21, and I think we are holding on to somewhere around 400 or 500 we had entered, and we are currently at 3008. So pretty dramatic sort of run up. I think the previous slide had Adani NNF10. Yeah, so maybe this is upside down. Adani Enterprise should have been up here, but nevertheless, so amazing sort of errand, and we were redistributing the profits all through, and we're still holding this. I mean, it's okay if it will come down, maybe that's fine. We'll suffer some drawdown on this. So essentially, don't let narratives rule your decision making. If you have created a system which has some rules, follow those rules. Whatever is the noise around it, don't worry about it. Interestingly, there was one tweet today that if only that only Reliance Industries has been part of the top 10 of Nifty 50 for the last 20 years. So all other stocks may have come to the top 10, and I believe this is talking about market capitalization, and then receded from top 10 into lower part of Nifty, or maybe have gotten out of Nifty. So the index itself is changing its constituents very rapidly over the last 10-20 years. A bunch of stocks which were there in 2000, 2003, 2005 are not there in Nifty anymore. A bunch of stocks which were there in maybe mid cap segment in that era are now in Nifty. So if you are following the index, you are actually already following some sort of a momentum strategy where stocks get updated on their own and you don't really care. But if you're following stocks per se and you get stuck with your idea that no, JP Infrastructure was in, JP Associate was part of Nifty, so I'll hold on to this stock, or Jet Airways was part of Nifty, so I'll hold on to that stock, or Yes Bank was part of Nifty, so I'll hold on to that stock. So that will not work for you. That will really be a detrimental strategy. So stick to index, but don't stick to index stocks as such. So the top stocks will always keep changing position, and within these 50 stocks also, the trends in these 50 stocks will be very varied. So at any point of time, Nifty may have 10 very trending stocks, 20 or 30, sort of midway, sideways type of trends, and 10 downward trending stocks. And the entire mixture of 50 stocks gives you the return of Nifty. But then why not have a system where you only want to pick those top trending stocks? So we have a private portfolio that we've been running that just does just that. It picks the top trending stocks and rebalances them on a monthly basis. And we are currently sort of gauging interest if you would like us to come out with that portfolio. So far the response on this my own tweet has been really encouraging. So people are looking for Nifty stocks and within Nifty a top trending sort of a subset of Nifty. So this is something that we will look at in the next few days. This is sort of a sneak preview at the strategy. So of course this is a back test, but on a monthly basis on Nifty level of constituents, with the survivorship bias having been taken care of, I mean, there is no room for slippage. There is no room for any other doubt in mind that maybe this back test was accurate, or will it replicate in real life or not. This on Nifty stocks, I can assure you that there is no such concern. At least I don't have that concern. So this strategy, if we had run from April 16, that's when weekend investing started, would have yielded 21.2% CAGR. And this is not even including the dividends, of roughly about 1 to 1.5% of dividend per year. So and Nifty of course was about 14%. Of course that is also not including dividend. So I mean, this is the kind of outperformance we can get from Nifty stocks. I mean, getting outperformance from small caps and mid caps, we've seen that in the last 6 years. We've done that multiple times in Nifty Next 50 also. But getting outperformance from Nifty is very, very difficult, because these are the 50 stocks which the entire world is focused on, and everybody wants to have that alpha above Nifty. And using Nifty stocks, if you can beat Nifty, I think that is really the biggest cream that you can get from here, because you have the least risk stocks, you have the most liquid stocks, you have the most well researched stocks, and the index is changing every 6 months by a few stocks every 6 months. So you are getting the benefit of that automatic rotation out of those stocks, and within those 50 stocks you get the top 10 trending at any point of time. So 1 minute a month, and if you can beat Nifty, at a low cost. I mean, what better could one get? I myself will be the first one to sort of run this in my portfolio, but this is something that we have been running on a backtest basis and on a simulation basis, but extremely positive results and extremely optimistic for a good run on this one. And one other insight here was that how has India fared since the start of COVID? A lot of people don't realize how well we have done since the COVID bottom. So this COVID bottom is here, March 2020, and we are about 2.5 years or maybe 2 years and 4 months into 2022. And I have divided the Nifty chart with USD INR so that we compare dollar to dollar basis, and the blue line is the S&P 500 index. Just see the kind of outperformance India has done versus the US markets. US markets are up 73 odd percent and India market is up 113%. A huge outperformance, and maybe this outperformance will continue for this next many years and possibly the decade. So a lot of folks did not come back after COVID. A lot of folks got out after the first bounce after COVID. A lot of folks are still waiting that markets will drop to 10,000 and then we will enter. So don't do all these mistakes. I have done all these mistakes in the last 25-27 years in the market. Please don't do these mistakes. Stay invested in the market. Keep gradually bringing in more money into the market. Spread out your money over a long period if the market has really shot up in the very recent past. But don't stay out of the market. That is a bad decision. And it has been repeated. These mistakes have been repeated several times over the last many decades. I have done the same. What I would suggest is, if you are out of the market, try to trickle in gradually. If you are in the market, don't worry about it, because if you have been in the market, you would have accumulated gains enough so that even if some external shock is to come, you have some buffer in place. So don't worry about market so much, and don't micro sort of analyze the market. Just have a global sort of perspective and have risk management in terms of asset allocation and diversification within your portfolio. That should be enough to get you a decent return. Just compound it over a long period. Try to have a good health so that you can compound over a longer period, and you can beat almost everybody out there. There's no question about it. So thank you so much for watching this and subscribing to the channel. Please do share it with your friends and family, and do let us know what you think about the content. Thank you. Bye-bye.